large part of the businesses which I've seen has been successful, which are able to really get on to what I call equity-based fundraising. And these fundraisings are then into different series. Series can be A, B, C, D, E. And most of the time it's up to C. And that's where logically the business has reached to a certain amount of size where it will go for an IPO or a buyout or some kind of a larger value creation for investors to really find their logical exits. But let's start with these series and understand these series a little more deeper into what these series would be all about. So Series A is essentially the first indication, or what I call the first performance indicator for you that you have now got a certain amount of commercial success. Now, this is a first revenue guidance structure. When you start with the early stage to go to angel and work with them, and when you get your first performance on board and you get to a certain size where the clear indication of stability and predictability of your revenue cycle have come in, and that is a time you can really approach a Series A. Series A is typically valuation case where the company can be valued anything between, say, anything above of 10 million to about 15, 20 million kind of a situation. That is a stage where the valuation is hit that you will do your first Series A round. Now, Series A again would mean a very important aspect for you, because at this stage you are attracting a venture capital, and these venture capital are large firms which go into a lot of due diligence, and not like more angels which are more impulsive and they're driven from their own equation with the founders and things of that nature. But this is now a venture capital. Venture capital would go deep down into understanding the business performance, and they also is now having some history. Now that history is very important, and how that history has really come in, and how the performance has happened. But if you are able to attract the right kind of Series A with the venture fund, I think that's the first milestone in your investment cycle. Now that investment cycle would mean how early performance has happened, how your ability now clearly demonstrate to really sweat out the capital. This is also another problem. A lot of people know they want to raise money. There is a good case to raise money, but they don't demonstrate how they want to sweat the capital out. Fundamentally, capital likes with people who have a very good ability and a clear ability to demonstrate how you want to sweat this out, and what is your scale story, how their scale story is going to be done. At that stage, you need to, normally it would be from a Series A to a Series B. It can be anything which is a 12-month, 18-month kind of a window, and that window is very clearly defined. And you normally would actually take the same investors of Series A to Series B, normally. And I've seen most of the time that case would happen because if they see that kind of a growth, the venture fund itself would step up and put the Series B back in the system. And that's a good case to be in. And that's a very, very good case to be in, because you will be able to stay and take the confidence back of the investors, and they back you again and put the Series B. Now, Series B essentially would mean that you have now scaled. So this is actually a scale-up time where really the companies start showing in, and you will start seeing the visibility. They're all out in the market. They're grabbing the customer base very, very fast. And the burn rate also at this stage from spreading out the equity or spreading out the capital would become much, much faster. And this would be a raise of anything, which is what I call, you will raise anything between 10 million to say about 15 million raise at a valuation case of anything which is 30, 40, 50 million kind of a valuation. So that's where the company really gets into the entire thing. I feel that a lot of businesses essentially find a challenge from Series A to Series B. I have found the lesser challenge for companies which have gone to a good cycle of angel investment. They normally wouldn't be able to attract a Series A, but Series A to Series B, I'm seeing a big problem happening these days because of expectation mismatch, growth mismatch, and things of that nature. At that stage, I think it creates a nervousness of earlier investors, which has come in Series A with you, to not reinvest back into the system, and that actually shows a little bit of less confidence in the outside world. Because it's the first question I would say when you are going for a Series B. If somebody would ask you that, why would your current investors not step up their investment? Because it's a good case, because they have already sitting in the business, they already know the business, they are with the founder very closely, so they've already invested. And why would this venture fund not step up and do that? It doesn't create a logic when they start shying away. Now, that's a very important aspect. How do you continue to have your existing investors' confidence back in the system is very, very integral part of the discussion. Now, at the Series C is very, very logical. That I have seen very little drop, because now the business has gotten into some kind of trajectory, and you will be able to go to the Series C. Normally, at this stage, you will start seeing the private equity funds really start participating, because this is getting into a little bit of a pre-IPO kind of a situation. At a pre-IPO kind of situation, a lot of great valuations go up, and the valuations can go up to 100 million plus. And this is where the companies logically become sizable organizations, and they would attract some very, very good, high quality private equity funds to come for a long-term investment in the businesses, because they can see that horizon for the business is 18 months to 2 years kind of an IPO. And that is a stage where companies would like to participate a little more. Now, this stage is normally at where the companies would logically go, and after that they would go for an IPO or a listing or a buyout or some kind of a structure would happen. But in very rare cases, there would be also going for a Series D. Now, Series D is a very opportunist approach. Opportunities means that sometimes companies feel that they still need to be private and they don't want to go for an IPO route, and there are other expansion opportunities coming in, which means that this looks like a global play. You were an Indian company and you were doing well, and there was a much bigger global play, which means a much bigger valuation case, much bigger opportunities to list in different markets rather than listing only in India. Like we've seen, a couple of our unicorns have now become OYO, started expanding in Europe, US, and the clear idea was that there can be a much more global play to do that. So they might go for another round of larger investment, because that's where the opportunity comes in. There also is a case where there is a down round to be done. Now, down round is essentially where your Series C has not performed from your revenue viewpoint, and you have actually not been able to do that. So a lot of people now, especially in these days, there is a lot of value correction which has started happening. And now that value correction means that the business has not performed. Especially now, you will see because of COVID, a lot of changes would happen in terms of the last valuation you got to this stage. And there is a pause period has come in, right? There's a period which you need to now pass because the business was on a different trajectory, and suddenly you got a dip and needs a rebuild capital and that thing. At that stage, you need to do a down round, which means at a lower valuation case, you need to still bring in money to keep the company afloat. So a lot of these businesses have got that. I mean, WeWork got that kind of situation where valuation were eroded, and then another round was infused at a much lower valuation. And this is normally pulled by the key investors. Because they feel that the larger erosion can happen and they want to keep the sustainability of the company, and then they would like to do that. Another round also is done, which is very, very rare, which is Series E, where I think the business has, for some reasons, have failed the expectation, or they feel that the business has to be kept private for various reasons, and there is a little more time for the company to be ready for public, or the markets are not ready. Sometimes the markets are also itself not ready, that they don't want to really have this institution. So a lot of these private equity funds would try to hold the company and try to keep it private. So these are different kind of a series which companies need to be doing.